For years, investors have been told that higher interest rates are bad for gold, but what happens when the Federal Reserve raises rates and the bond market refuses to believe the policy will work? The answer could determine where gold goes next, because beneath the headlines about Trump's new Fed chair lies a much larger problem involving U.S. debt, Treasury yields, inflation, and the cost of refinancing America's obligations. And if the Fed's strategy begins to fail, the policy designed to pressure gold could become the very force that sends it higher. The most important development, however, may be happening somewhere investors are barely watching. Welcome to Precious Metals Intelligence, where major economic developments are examined through the lens of markets, monetary policy, and long-term wealth preservation. The channel invites viewers to follow and subscribe for future analysis, and viewers are also encouraged to share where they are watching from, because the consequences of these monetary decisions extend far beyond Wall Street and Washington. The first question facing gold investors is simple, but the answer is much more complicated. Why could Trump's new Federal Reserve chair put serious pressure on gold? At first, the explanation seems straightforward. A more hawkish Federal Reserve usually means higher interest rates, and higher rates tend to reduce the appeal of gold. Gold does not generate income. It does not pay interest, dividends, or yield. It simply stores value. So when cash and government bonds begin offering strong returns, investors often rotate away from gold and into interest-bearing assets. That is the basic argument behind the expected downside pressure. But that explanation only captures the surface of the story. A hawkish central banker is someone who prioritizes controlling inflation, even if it means keeping interest rates high for longer. A dovish central banker is more willing to cut rates to support growth, even if inflation remains sticky. Trump's new Fed chair is being viewed through a hawkish lens, and that perception alone can move markets. Financial markets do not wait for policy to change. They react to expectations. If investors believe rates will stay elevated for an extended period, gold can come under pressure simply because holding it becomes more expensive in relative terms. This is where the concept of opportunity cost becomes important. When cash or bonds offer meaningful returns, holding a non-yielding asset like gold becomes harder to justify. Investors are constantly comparing what they give up by holding one asset instead of another. If safe government bonds pay 4 to 5%, gold must compete against that return without offering income of its own. The situation becomes even more sensitive when inflation is included. What matters is not just the nominal interest rate, but the real interest rate, the return after inflation is deducted. For example, if interest rates are 4% and inflation is 3.3%, the real return is only 0.7%. That small difference can still matter a great deal for large institutional investors. When real yields rise, cash and bonds become more attractive relative to gold. When real yields fall, gold tends to benefit. This is why a hawkish Federal Reserve can initially create a difficult environment for precious metals. If the new Fed chair keeps rates high long enough, inflation may gradually decline. If inflation falls while rates remain elevated, real yields rise. And if real yields rise, investors have a stronger incentive to hold interest-bearing assets instead of gold. That is the core mechanism behind the bearish argument. However, that is only part of the system. The Federal Reserve does not control all interest rates. It directly influences short-term rates, which affect savings accounts, credit cards, and short-duration borrowing. But long-term rates, such as 10-year or 30-year Treasury yields, are determined by the bond market. Investors decide what return they require to lend money to the U.S. government over long periods of time. This distinction is critical. If investors believe inflation is under control, long-term yields can fall even if short-term rates remain high. That would allow the government to refinance debt more cheaply and would reinforce the bearish case for gold. But if investors remain unconvinced, long-term yields may stay elevated regardless of Federal Reserve policy. That is where the tension begins. The United States carries a very large and constantly growing debt load. As older debt matures, it must be refinanced at current market rates. If long-term borrowing costs remain high, the government's interest burden increases over time. This creates pressure that monetary policy alone cannot easily solve, and this is the contradiction investors need to understand. A hawkish Federal Reserve may succeed in making cash more attractive in the short term. But if the bond market refuses to lower long-term yields, the cost of government borrowing continues to rise. At that point, policymakers face a difficult choice: maintain tight policy and accept higher debt costs, or find ways to influence long-term rates more directly. That leads to three possible outcomes. Policymakers could successfully restore confidence and bring long-term yields down. They could accept higher borrowing costs and continue refinancing debt at elevated rates, or they could eventually intervene more directly in the bond market to prevent yields from rising too far. Each path carries different implications for gold. The first is potentially bearish, as strong real yields reduce demand for non-yielding assets. The second increases fiscal pressure and can strengthen the long-term case for gold. The third introduces monetary risks that can also support gold over time. So the real question is not whether a hawkish Fed chair can pressure gold in the short term. It is whether that policy can actually solve the deeper issue in the bond market. If it can, gold may remain under pressure for longer than expected. If it cannot, the very policy designed to weaken gold could eventually create the conditions for its next major move higher. There's a point in every debt cycle when the headline interest rate stops being the most important number, and the identity of the lenders becomes more important than the policymakers setting the rate. That point is becoming increasingly relevant for the United States because the Federal Reserve can influence short-term borrowing costs, but it cannot force investors to accept low returns on long-term government debt. That distinction is critical for understanding the gold market. The Federal Reserve controls the short end of the yield curve. It can raise or lower policy rates, which then ripple through credit cards, mortgages, and short-term loans. But a 30-year Treasury bond is different. It is a long-duration promise, and investors demand compensation for inflation risk, currency uncertainty, and the possibility that future dollars will be worth less than today's. That is why Treasury auctions matter so much. When the U.S. government borrows, it does not set the price of that borrowing unilaterally. It offers bonds, and the market decides what yield is acceptable. If demand is strong, yields stay contained. If demand weakens, the government must offer higher returns to attract buyers. In other words, confidence determines price. For gold investors, this mechanism is far more important than it appears on the surface. The United States is not dealing with a small or temporary borrowing need. It is managing a massive stock of outstanding debt that must constantly be refinanced. Bonds mature, and when they do, they must either be repaid or replaced with new issuance. This refinancing process means that past borrowing decisions are continuously repriced by current market conditions. If older debt was issued at low interest rates and must now be rolled over at significantly higher yields, the cost of maintaining that debt rises sharply. The problem compounds as more of the debt stock matures over time. This is where the tension between monetary policy and fiscal reality becomes visible. A hawkish Federal Reserve is typically associated with restoring price stability and strengthening confidence in the currency. In theory, that should eventually reduce inflation expectations and lower long-term yields. But that outcome is not guaranteed. If investors remain concerned about structural deficits, persistent issuance, or long-term inflation risk, they may continue demanding higher compensation regardless of short-term policy rates. In that scenario, the Federal Reserve can keep short-term rates elevated, but the Treasury still faces high borrowing costs on the long end of the curve. That creates a fiscal squeeze. Interest payments begin to consume a larger share of government revenue. More borrowing is required simply to service existing debt, and the system becomes increasingly sensitive to changes in market sentiment. At that point, the bond market is no longer just pricing inflation expectations. It is pricing sustainability. This is where gold becomes more than just a reaction to interest rates. It becomes a reflection of confidence in the entire debt structure. If investors believe the Federal Reserve can successfully anchor inflation and stabilize long-term yields, gold faces headwinds. Higher real yields make cash and bonds more attractive relative to non-yielding assets. But if investors doubt that long-term yields can be contained without additional intervention, the picture changes. Gold does not depend on the credit system. It does not require refinancing. It does not rely on government balance sheets or central bank credibility. It exists outside the debt structure that is being questioned. That is why a hawkish Federal Reserve does not automatically translate into a sustained decline in gold. The metal responds not just to policy rates, but to the credibility of the entire monetary framework. If long-term yields remain elevated despite restrictive policy, it signals that the bond market is demanding more compensation than policymakers can easily deliver. And if that pressure continues, policymakers may eventually face a difficult choice: accept higher borrowing costs or intervene more directly in the Treasury market to prevent yields from rising further. Either path carries consequences. And in both cases, the bond market, not the central bank, ultimately determines the constraints. That is why the most important signal is not the next rate decision, but whether investors continue to trust that long-term U.S. debt can be financed without extraordinary measures. Because once that trust begins to weaken, the pressure does not disappear. It moves into the very asset that has historically been used when confidence in paper promises starts to fade. The pressure on the U.S. Treasury market does not come only from American investors. One of the most important forces can come from overseas, and Japan sits near the center of that story. Japan has been one of the largest foreign holders of U.S. government debt, which means decisions made in Tokyo can influence the cost of borrowing in Washington. If Japan ever needs to sell a significant amount of those Treasury securities, the consequences could reach far beyond the currency market. They could affect bond yields, government financing costs, and ultimately the long-term outlook for gold. Japan has a particular problem. Its currency has faced prolonged pressure against the U.S. dollar, and a weaker yen makes imported goods more expensive for Japanese households and businesses. Japan relies heavily on imported energy and other commodities. When the yen loses value, those imports become more expensive in local currency. That creates pressure on the domestic economy and increases the importance of stabilizing the yen. Japan needs access to US dollars because the dollar remains central to global trade and financial markets. One way for a country to obtain dollars is to use some of its foreign reserves. For Japan, that can create an uncomfortable choice. If it sells part of its US Treasury holdings to obtain dollars or support its currency, it could increase the supply of Treasury securities entering the market. When a large holder sells government bonds, the market has to absorb those securities. If buyers are not willing to purchase them at existing prices, the price must fall until the yield becomes attractive enough. In simple terms, more selling pressure can mean higher yields. Higher Treasury yields are exactly what Washington does not want if it is trying to reduce long-term borrowing costs. This creates an unusual chain reaction. Japan may want to protect the yen. To do that, it may need dollars. To obtain those dollars, it could reduce some exposure to US debt. That selling pressure could push Treasury yields higher. Higher yields would then increase the cost of financing US government debt. The difficulty is that neither country has complete control over the process. Japan cannot simply command the bond market to absorb its securities at favorable prices. Washington cannot simply command Japan to hold every Treasury bond forever. Both countries are responding to their own financial pressures. That is why international Treasury ownership matters so much. For years, foreign governments have been important buyers of US debt. Their willingness to hold Treasuries has helped provide a deep market for American borrowing. But if foreign demand becomes weaker, while the United States continues issuing large amounts of new debt, the burden shifts toward other buyers. Those buyers may demand higher returns. The result could be a long-term yield that remains elevated even when the Federal Reserve is trying to maintain restrictive monetary policy for the purpose of controlling inflation. This is where policymakers can become trapped between two objectives. On one side, the Federal Reserve wants financial conditions tight enough to prevent inflation from returning. On the other side, the Treasury wants borrowing costs low enough to manage the enormous amount of debt already outstanding. Those objectives can coexist when long-term yields remain under control. They become much harder to reconcile when yields begin moving sharply higher. That tension helps explain why policymakers may look for ways to prevent large foreign sales from creating additional pressure in the Treasury market. One possible approach is to provide liquidity without forcing Treasury securities into the open market immediately. Instead of selling bonds directly, a foreign holder could potentially use those securities as collateral in exchange for dollars, allowing the holder to obtain liquidity without creating the same immediate wave of bond selling. For the Treasury market, that distinction can be significant. If securities are sold openly, new supply must be absorbed by investors. If they are temporarily used to obtain liquidity, the immediate selling pressure can be reduced. They show how closely connected the Federal Reserve, the Treasury, foreign central banks, currencies, and government debt have become. The Federal Reserve is designed to operate independently from political authorities, while the Treasury manages the government's borrowing needs. Yet, when rising yields threaten the cost of federal financing, the two institutions can face powerful incentives to coordinate. For gold investors, this is not simply a story about Japan. It is a warning about the structure of the global financial system. Gold becomes particularly important when confidence in traditional financial arrangements begins to weaken. If foreign governments become less willing to accumulate U.S. debt, if investors demand higher compensation for lending to Washington, and if policymakers increasingly intervene to stabilize the Treasury market, the underlying monetary environment can change. The short-term effect could still be negative for gold. Higher real rates can attract capital toward dollars and bonds. Investors could reduce precious metals exposure while they wait for clearer signals from the Federal Reserve. If policymakers eventually need extraordinary measures to keep Treasury yields from rising too far, investors may begin asking whether monetary stability is being placed behind fiscal stability. That distinction matters, because gold has historically attracted attention when confidence in paper assets, currencies, or government finances becomes uncertain. The key issue, therefore, is not whether Japan sells a specific amount of Treasury debt. The larger issue is what such selling would reveal. If major foreign holders need to reduce their exposure while Washington simultaneously needs lower borrowing costs, the Treasury market could become a critical pressure point. And once that pressure point becomes impossible to ignore, policymakers may face a choice that directly affects the future of gold. They could allow the market to determine the price of long-term debt, accept the consequences of higher yields, or intervene more aggressively. To understand what happens next, it helps to step back from the day-to-day noise of interest rate decisions and look at the structure underneath. The United States is not just dealing with a temporary inflation cycle or a short-term tightening phase. It is managing a long-term debt system that depends on continuous refinancing, stable demand for government bonds, and confidence that future dollars will hold their value. When all three of those conditions are strong, the system feels stable. When even one begins to weaken, pressure builds quietly at first, and then suddenly becomes visible in markets. Right now, the most important tension is not between stocks and bonds, or even between inflation and growth. It is between fiscal reality and monetary control. The Federal Reserve can influence the price of money in the short term, but it cannot fully control the willingness of investors to lend to the government over decades. That distinction becomes critical when debt levels are already extremely high and rising. If long-term investors begin to demand higher compensation for risk, the entire structure becomes more expensive to maintain. And once that process starts, it is very difficult to reverse without changing the rules of the system itself. This is where the three paths described earlier begin to converge into a single, uncomfortable reality. None of them are painless. If policymakers succeed in restoring confidence and long-term yields fall, the system stabilizes, but only if investors truly believe inflation is permanently under control. That requires not just restrictive policy, but sustained credibility over time. One or two good inflation readings are not enough. Markets need to believe that the discipline will last even when political pressure increases, even when growth slows, and even when debt servicing becomes politically sensitive. That is a high bar. If policymakers instead accept higher yields, the system remains market-driven, but the cost of that discipline is paid directly in fiscal terms. Interest payments rise, deficits become harder to control, and the government's dependence on new borrowing increases. This does not immediately break the system, but it slowly reduces flexibility. Over time, more of the budget is consumed by interest rather than investment, defense, or social programs. That changes the political economy of the country in subtle but important ways. And then there is the third path, the one that markets often underestimate until it begins to happen. If long-term yields rise to levels that threaten fiscal stability, policymakers may feel compelled to step in more directly. This does not necessarily mean a dramatic announcement or a single policy shift. It can begin quietly, changes in bond buying programs, adjustments in liquidity operations, or increased coordination between fiscal and monetary authorities during periods of stress. The goal in such a scenario is not to eliminate market pricing, but to prevent disorderly moves in borrowing costs. However, once the central bank becomes a consistent backstop for government debt, the perception of risk changes. Investors begin to understand that the price of long-term money is no longer determined purely by supply and demand. It is influenced by policy objectives. That perception is where gold begins to re-enter the conversation in a more powerful way. Gold does not depend on any government's ability to maintain a bond market. It does not rely on the credibility of fiscal projections or the stability of long-term interest rates. It exists outside the system that is under pressure. That is why, historically, gold tends to attract attention not when systems are stable, but when confidence in the long-term structure of money begins to weaken. Importantly, this does not require a crisis. It only requires uncertainty about the future path of policy. Even in a functioning system, investors begin to ask questions when they see persistent intervention in markets that were previously left to price freely. They begin to wonder whether the true cost of capital is being accurately reflected. And when that question becomes widespread enough, capital starts to look for alternatives that are not tied to policy decisions. That is the subtle shift that matters most. At first, gold may not respond dramatically. In fact, it can fall during periods when real yields rise and the dollar strengthens. That is the short-term narrative that often dominates headlines. But beneath that movement, a different process can be forming, gradual reevaluation of what constitutes safe long-term value. If government bonds are perceived as increasingly dependent on policy support, and if inflation remains structurally higher than in previous decades, then the traditional relationship between bonds and safety begins to weaken. In that environment, gold does not need a crisis to perform well. It only needs a slow erosion of confidence in paper-based stores of value. This is why the most important developments for gold are not always visible in price charts. They appear in funding markets, in central bank behavior, in foreign reserve decisions, and in the structure of Treasury demand. When foreign holders begin to adjust exposure, when domestic institutions become more sensitive to duration risk, and when policymakers begin discussing yield stability more frequently, those are early signals of stress in the system, not necessarily collapse, but adjustment. The United States still has enormous advantages. It issues the world's reserve currency. Its financial markets are deep and liquid. Its treasury market remains the benchmark for global risk-free assets. These are powerful stabilizing forces, and they should not be underestimated. But even strong systems have constraints. The constraint in this case is mathematical as much as it is political. A large and growing debt stock must be financed. If the cost of financing rises faster than the economy's ability to generate revenue, something eventually has to adjust. That adjustment can come through growth, through inflation, through fiscal policy, or through financial repression. Each option has different consequences for different assets. Gold sits at the intersection of those outcomes. If growth is strong and inflation is controlled, gold struggles. If inflation remains persistent, gold gains support. If financial repression becomes more visible, meaning real returns on government debt are held down through policy, gold can benefit even without a crisis. This is why the current environment is so important. It is not defined by a single outcome, but by competing pressures that pull the system in different directions at the same time. The Federal Reserve may attempt to maintain credibility through restrictive policy. The Treasury may attempt to manage borrowing costs through issuance strategy. Foreign holders may adjust exposure based on currency needs, and markets will continuously reassess whether the system is moving toward stability or toward greater intervention. Gold reacts to all of these forces, but not always immediately. The real risk for investors is misinterpreting timing as direction. A temporary decline in gold does not necessarily mean the long-term thesis has failed. It may simply reflect a phase in which monetary tightening is still dominant. Likewise, a short-term rally does not guarantee a sustained trend if real yields remain high and confidence in policy remains strong. The deeper question is not what gold does next month, but what kind of monetary system is emerging over the next several years. If that system remains anchored in credible inflation control and sustainable debt dynamics, gold may face a prolonged period of pressure. If it shifts toward higher debt dependence, persistent refinancing needs, and increasing policy intervention in bond markets, gold's role in portfolios may gradually expand again. And if policymakers eventually find themselves forced to choose between financial stability and fiscal flexibility, the outcome of that choice will likely define the next major phase of the gold market. At that point, the question will no longer be whether the Federal Reserve can pressure gold. It will be whether the structure supporting the entire bond market can continue to function without changing the nature of money itself. And once that question becomes unavoidable, gold stops being a trade and starts becoming a reflection of the system's limits.